Hello, ladies and gentlemen. My name is Greg Michalowski. I am the Director of Client Education and Technical Analysis for ForexLive.com, and this is a special webinar that I'm going to be giving here for FX Street. It's going to be on the Fed decision and how to trade it. So it should be, well, hopefully interesting and enlightening for you on how I look at such a key decision, a risky um, trading environment as well. So speaking of risk, this is our risk disclaimer. Let me warn everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage could create additional risk and loss exposure should you decide to trade foreign exchange. Carefully consider your investment objectives, your experience level, and your risk tolerance. You can lose all or part of your risk capital in the foreign exchange market. So be aware and be prepared, especially going into this huge risk event. It's finally here. The September Fed rate decision, which, quite frankly, they've been backing themselves into the corner as time has gone by this year. Remember the dot graphs and all that other stuff that said the Fed funds effective rate would be, I don't know, probably near over 1% or higher at the end of last year. That was their projections. And here we are coming into September with only the September and then the October decision, which doesn't have a press conference. And then we get into the holiday Fed decision in December, which no one likes the Fed to tighten during December, do they? What a Grinch if they were to do that. It gets to the point where the market was pinpointing into this September decision as being the time when we'd finally get this quote unquote liftoff. 3, 2, 1, liftoff. I don't know. I don't know about you. When I think about a liftoff, I think I see rocket ships moving up at the speed of whatever a rocket ship goes at. Looks like it's slow, but I'm sure it's much faster than it looks. But that's not what we're going to get with the Fed decision. We're going to get a slow liftoff, especially given all the stuff that's going on. So what do we know? Let's pretend that we are on the Fed board, and we're kind of looking at all the stuff that's going on. And for me, it's a toss up. If we take a look at things like the CPI year on year, we saw that, I guess, come out here today. Honestly, my head was down all the way to the last minute putting together slides for this presentation, but the CPI year on year plus 0.2, that's not quite near the 2% target that the Fed is looking at. But if you take a look at the core CPI, I think it came in at 1.7, right? So 1.8 was last month, or the prior month. This month, the most recent one, which came out this morning, I think came in at 1.7 for the year on year core. That's closer than the 2%. And as you can see, for the most part, over the last few years, the core has been below 2%, down as low as 1.6. So pretty steady there for the core inflation. So, 6 of one, a half a dozen the other there, right near the 2% target. Let's take a look at the GDP. Up and down, we seem to, I don't know, the pattern seems to be start slow, beginning of the year, then move up, and toward the end of the year, and that seems to be a pattern here. Here we had 3.7% GDP growth reported in the second quarter. The first quarter was, as you can see, closer to 0%. So GDP is one bad, one good, and we have all the future to look forward. So kind of up and down. And another inflation gauge, the core PCE, not necessarily going the same way that the CPI core measure was going, where we're sitting up there near the 1.7, 1.8, closer to 2%. Here we are moving more to the downside, 1.23. Not exactly, the kind of core PCE that the Federal Reserve want to see as far as that inflation goes. Existing home sales, what's happening in the home front? We're seeing home sales nice and strong, 5.59. I think that's near the high. In fact, it is the high high price on this graph going back to 2009. It may not, it may actually be a multi-decade long high as well. So home sales are going well here in the United States. So that's good news for the economy. And the median price of the home sales are up 52% since 2012. Right here, not a bad move in there. So that's good news. Kind of offsetting the inflation negative news. Then we have the unemployment rate coming down from 10% all the way down to 5.1%, steady decline. And the number of jobs that have been created have also been pretty steady. Now, the thing about this non-farm payrolls jobs is, yeah, they're not accelerating like in 2014. We actually had an acceleration of the job growth in 2014. So in 2015, it's lower, somewhere around 200,000. I think 2014, the average job gain was job gain for the month on non-farm payroll was about 260,000. But if you look back, going back to 2011, we pretty much added about 180 to about 220 on average every month. So this is accumulating job gains every month, which is pretty steady, and it adds up over time. So as far as the employment, if you take a look at the employment rate and then you take a look at the non-farm payroll jobs, not bad. That's a good side of the equation. Now there admittedly probably a lot of you out there that are saying, hogwash and poppycock. That ain't true. A lot of people are taking jobs that pay a lot less. Yes, a lot of people have left the workforce. Yes, the participation rate is down. We don't hear about that much anymore. Market seems to have accepted that. Maybe people are retiring, stuff like that, or demographic shifts, and so there are these mixed signals that are going on in the market from the job perspective. But overall, I think the Federal Reserve is encouraged by the steadiness of the job gains out there and the consistency that we're seeing not only in the non-farm payrolls but also in the decline in the going the wrong way in the unemployment rate, the steady decline. 5% what is a pretty decent rate. Taking a sip. Pretty low rate. Remember back when I think it was around 2012 when the Fed was saying that if the unemployment rate goes to 6.5%, that will be a trigger point, or the level that they would start to take back some of the excessive easing that they've done. Well, that came and went, and it was just another indication of the Fed kind of painting themselves in the corner. But 5% unemployment rate on the surface, not a bad thing. Non-farm payroll jobs around 200,000. Now, what's going on in the stock market? Stock market since 2011 moved up. Well, currently up around 80%. That's not bad. Was higher. We've come down a bit, testing our lows here from 2014, or the swing low from 2014. You can't really, even with this move to the downside, you can't really complain about that. That's been stimulated to the economy over time. More money in people's pockets, or they're increasing their balance sheet. Or their balance sheets are getting more healthy. When you take a look at the European stock market, yes, come down off the top here, but up 63% since 2011. The Shanghai Composite, a little more rough time of it, and that's been a big focus of late, is the China syndrome, the China issues, the China transition, which the second largest economy in the world. It's hard to ignore. But the Fed may just do that. This was artificially stimulated, perhaps from getting retail mom and pops in the market there, with saying the government's all behind this, and then boom, crash right back down to from whence it started. So it's up over the last year or so. but from a low level right here, but certainly well off the highs. Who knows? China's a big wild card out there. Commodity prices, we know about them declining to the downside. So that again is an inflation thing that would keep the Fed from perhaps tightening. And crude oil down quite low. Iron ore prices, another measure of commodities down very at low levels, down well from 180, 190 all the way down to 57. That's a big, huge move to the downside. And 10-year note yields kind of sitting in the middle of a range here over the last 4 or 5 years. It's kind of waiting around, see what the Fed's going to do, see what the economy's going to do going forward. And finally, the dollar index. So what we've seen in the dollar index is a 20% increase from this low right here last year to the current levels here. So that in effect can be a tightening for the Fed. It may stop them from tightening credit conditions in their meeting tomorrow, and that is because of that move to the upside here. Makes it it does the Fed's tightening for itself. For the Fed, so some people have argued that. And what do we know about the Fed funds target, though, is that the Fed funds target has been flatlined here for, I don't know, what is it, 9 years now? Or 8 years, 9 years, I don't even know. No, but we've been down at 0.25, so it has been down there low for a long time. And so all of this, all these charts, all this fundamentals, if you will, go into this big pot, this big cauldron, and make it a real difficult decision for the Fed. And honestly, looking at it, it's like employment's doing well. It could be a time for that employment starts to kick in more inflationary wage gains going forward. And that, I think, is what the Fed, if they are to tighten, will be focused on, is that it may not be there now, but down the road there's going to be some wage inflation. So what is my opinion? Well, if I were to have to get on, make a choice one way or the other, I would say that the Fed will start liftoff. Start their liftoff and raise rates by 0.25%. Understand that I am human, and this chart that I showed prior, with the Fed funds target sitting here at flatline for so long, after I'm not a youngin like a lot of you, or maybe not, but I remember my career started way back here, and I've always been for most of my career, I've been in a trading markets that move up and down with the Fed funds target. The Fed eases rates, they lower rates, they ease rate and lower rates. So it is kind of human nature for someone as old as me to kind of look for the change, the change. Things just don't stay the same as far as the Fed target forever and ever. That's the way I lived for all the way up until 2010 or whatever, when 2009, 2010. So it. That my idea that the Fed is going to tighten may be biased that way. But what I think is the Fed painting themselves in the corner. They'll not be. I think they'll not be influenced by global turmoil, rightly or wrongly, but instead focus on the domestic issues. The job growth has been steady at plus 200,000 for a number of years. The employment rate has declined from 10% to near 5%. Once again, remember when they said that they would tighten at 6.5% or start to tighten at 6.5, we're 1.4% lower than that right now. They, of course, in their decision will have all sorts of caveats and disclaimers about the projection of rates. That's nothing new. And I think that by doing so, if they do tighten and they do have all these different caveats, they're just going to introduce more uncertainty, because they really don't know what the market really will not know what the trigger will be for the next rise, or when, or maybe if it comes back down, what would be that trigger. So it's kind of that idea that think of the Fed as someone who's has a paintbrush in their hands, and they constantly paint themselves in the corner, even though they try to be more transparent to the market in the process. They end up, kind of setting themselves in the corner, and this kind of all this data and all this stuff that we've seen right now is kind of the culmination of that, throwing the stock market's declines and all that other stuff, and and you get to the point where the Fed said that they were going to tighten in 2015, and we're still on course for tightening in 2015. And then you get to the point where you got September, October, and December, and October may not be a good meeting, and December might be a holiday meeting, and so September really is it. So they kind of painted themselves into that corner, and now they're going to come in and they're going to say things like, well, the projection of rates is not going to be, don't expect it every month. Well, when can you expect it? That's what the market wants to trade on. So there's just going to be all sorts of uncertainty going forward. That's just my opinion as well. Now, my question to you is, does my opinion matter about all this stuff that I've just gone through? And the answer to that is no, spells no, because what I think doesn't really matter. It's what the market thinks that matters, ladies and gentlemen, especially us retail traders. Now, when I say the market, I'm doing bunny ears. I'm putting my bunny ears up, my quotation marks around the market, and those are who the big boys, the guys who can move the market. We as retail traders out there cannot move the market. We can't move it one single pip. And so, so we are at the mercy of the market. And I've already demonstrated that it's kind of, through all the fundamentals, I guess, that if I were sitting there in the Fed meeting starting today and continue on tomorrow, I would be, I'm sure there's big debate going on about, is it inflation? Is it growth? Are we going to see inflation? Or are we going to see growth? By the way, the Fed hasn't been very good at projecting. Tomorrow they're also going to release their what do they call them? I forget the projections for economic growth and inflation. They haven't been very good at doing that over the last few years. Anyway, they always see higher inflation, they always see higher growth, and they have to come back down. And so they're not very good at what they do anyway. So, but there's going to be a debate going on. So, my opinion doesn't matter. The only opinion, the opinion that matters is the market's reaction, and I guess the Fed. And so, really, the Fed first, because they're the one who's going to make the decision, and then the market's reaction. The market, those big guys, not us, little lowly traders who are just the barnacles on the back of a whale, feeding off of the price movement. So what are our options as traders? How do we trade this? And for me, risk is too great. Okay, if it's a 50-50 thing, I'm not a gambler. Really, I'm not a gambler, and I don't really want to be sitting here in my seat, where in front of you. Nor do I think it's ethical, I guess, in my respect, to say that given all that stuff that I just showed you, that win or lose, have a booze, go for it. They're going to tighten, so look to buy the dollar and ride it to the sunset. I know we're all paid to have opinions and trade, but we're also here to trade, to try to make money. And put the odds of success in our favor. If the odds are a 50-50, then just go to Atlantic City, get some free drinks. Atlantic City, I think they closed down Atlantic City. Go to Las Vegas, get some free drinks, enjoy the scenery, and put it on black or red or something like that. You can always do that. So risk is too great. The market is likely to be extremely volatile. There could be sharp moves up and down. And liquidity conditions are likely to be light. There's a question of how the stock market takes and whether we have risk on, risk off trades as a result, and what does the bond market do as well. I got to think that all those things are going to be mashed up at 2 o'clock tomorrow when the interest rate decision is announced, and then Janet Yellen starts to speak. And we're going to get all sorts of volatility and sharp moves up and down. So what can we do? We can trade the aftermarket, the afterlife, after the event. We could also choose not to trade it at all and just wait for the market to settle down and trade it the next day or the next day after that. There's always an option, friends, and that is that there's always going to be another trade. There's always going to be another day where you're going to have that opportunity to trade the market and make money. And when it's less risky, when it's less volatile, when it's less choppy, when there's more certainty in the market. So that's always an option too. But I'm not going to send you into this non-farm or into this interest rate decision with the position. I don't think that's a thing that you should strive to do. But we can talk about trading the aftermarket, and that aftermarket can be any time after that decision, after the things are known. Now, we're going to get the statement, and hopefully the statement is pretty succinct, and we can expect then what Janet Yellen might have to say when she starts her press conference. But it may be that there is still some ambiguity. So it may be that we have to wait until 245 or so, or 250 to really let the market settle down into its rhythm. But once it reaches that rhythm, I think I often find that the technicals play a key role in determining things like bullish or bearish bias. The dollar's going to go higher or lower, and so that's what I'm going to spend the rest of the time here on in this webinar is talking about what levels are going to be key for. I'm going to look at the euro and the dollar yen, and I want to teach you in the process my thought process on how to not only trade this event, but also other key events or other big events that have the potential to really move the market. And it has to do with looking at charts, applying tools, some simple tools that I feel and know really that the market pays attention to. And I'm going to show that by outlining those levels, and they're going to be levels that kind of stick out. And when we trade the market, if we have a level that kind of sticks out, we know that it becomes what I call a borderline. A borderline is a line or an area that determines bullish above, bearish below. And so we know, for instance, that the euro versus US dollar is right around here, 112, I don't know, 59. It's probably a little higher than that. I did this early this morning. But let's just say it's that 112.59. And so that level and other tools applied to this chart is going to tell you something about the bullish or bearishness of the chart. Now, I want to set you up by explaining a few little things in the chart. The green line here represents the 200 moving average. Now, I'm on a daily chart, and the other thing that I like to do in going into these numbers is take a look at the big picture, okay, the daily chart, and then kind of move into an hourly picture, kind of refine certain levels. And what I'm going to be doing here today is just looking for levels that I think are important levels. And so if the price is above that important level, that's bullish. If the price goes below it, then that's bearish. And then look at the next level above, and the next level above that, and next level above that, and then go the other way. Look at the next level below, the next level below that, the next level below that, and those become targets. So we are right here at, let's just assume 112.59, and tomorrow we're going to be at some different level, but basically this chart's going to remain the same. So you can copy all my little lines and stuff, and I'm going to explain why levels are important in this chart from what I see. Remember last month's webinar, I talked about what do you see in the chart? So let's go through what I see in the chart. Well, let's just take a broad view of this market right here. And this is a daily chart again, and these are months. Calendar months divided up by these dashed lines. So we can go back and say this is 1 month, this is February, March, that's 2 months, 3 months, 4, 5, 6, 7. 7.5 months of data here. And what can we say about this data? Well, most of the trading has taken place between these yellow areas right here, right? I think you'd agree we had a move to the downside here, move to the downside here, move to the downside here. The market was trying, on its way to parity. Remember, we were waiting for that parity move there at this time right here. So it was more bearish here, and then all things started to fall apart here in April, and we haven't been below the 108 level since April. So let's discount this area right here, these extremes down here, and look at just this box right here. And most of the activity has been in that box. Now, we did have a move to the upside here where we squeezed like heck and moved all the way up to the 117.11. But I think we can say 108, 114.65 is where the market has been trading. So that's the big picture. That's the big broad picture. Now let's break it down and look and find the levels that are going to be important going forward. Now, let's just break it down, starting at the bottom extreme and work our way to the upside. Okay, so here we are here at 112.59ish, something like that, And I'm gonna come down to this bottom here. I'm gonna say that that what I see is a lot of different lows through here. Okay, we have one there. There's really two right here. We have 3 right here. We have 4 right here. We have 5 right here. We have 6 and 7 right there. So one extra one through here. So the first thing that I want to outline is this area right here at 108.07 to 62. Now we're way up here at 112, so that's 400 pips away, but that is going to be a level of importance going forward. The next thing I want to point out is this blue line. This blue line represents the 100-day moving average. I think I talked about the green line, which is a 200. The blue line is the 100-day moving average. We're on a daily chart right here. And here in most recent times, we've been finding support against the 100-day moving average, haven't we? We had one day where the market closed below that level here. The market should have gone lower here. It didn't. The next day it moved back higher above that level, moved higher. In this month, the month of September, we actually had two different days where the market went below the 100-day moving average and couldn't close below that level. And so are we surprised that on this day right here, number 5 right here, the fifth test of the 100-day moving average, market found support against it. We moved higher one day, we came back down again, found support against it too. So we've seen a pattern now where we're finding support against the 100-day moving average. So instead of the 108.07 up to 108.63, now we have a closer level up here, all the way up to 111.43 is where the 100-day moving average is. If we move below that level, that would be more bearish, wouldn't it? That would be more bearish and stayed below it, because over the last month of trading, we haven't been able to stay and close below the 100-day moving average. So that is a pretty important level. And with the market trading at 112, let's call it 59, well, the 111.43 level is definitely something in play. So we know from tomorrow's announcement, if the dollar should start getting stronger and move and stay below the 111.43 level, it's going to be a little higher tomorrow, that is going to be a bearish bias. You can expect that the market is going to shift its focus more to the downside and start to explore further to the downside. And so what does that mean? That means that you can lean against this level. So assume that you have no position and the Fed tightens and the comments are more hawkish and the dollar goes stronger and the euro goes down below the 111.43 level and it comes down to 111.20, and you can at that time say, I'll sell at 111.20. I'm going to put my stop at a 111.43. Now I want to bring up another level right here. That's a 61.8% retracement of this 3-month trading range right here. Actually, it's more than that. This is the low for the last 5 months. This is the high for the last 5 months. So this level is also in play here. So 111.43 to 52, that area is going to be a key level area tomorrow. Okay, it's going to be a key area. Get and stay below that level is more bearish. Yes, you know, the smart guy who knew the Fed was going to tighten and knew that the dollar would get stronger, maybe selling up here, and you might be selling down here, but you don't have to live through that event risk. And that's a big thing. And I would pay 120 pips, 130 pips to not have to live through that risk, because it can go 300 pips to the upside too. Okay, or 200 pips or 120 pips to the upside too. And I'm not in a gambling mood. So I'd be willing to wait for the market to get below this key area right here with the 100-day moving average 61.8%. So earmark that level as a key level. 100-day moving average 61.8%. That getting and staying below that level is going to be important. Now let's take a look at another level that's even closer. Okay, and I'll show you why this level is important as well. This comes in at the 112.13-ish level. We have a high right here. This is a swing high right here. We can all see that, right? Everyone can see that. We come down here to our bottom area right here where we found support. We moved higher. We came down again, and we based, and we came right up to that swing area right there. This is a remembered line, okay? It's like this area. It's a remembered area here. The market remembered it. That's why it keeps on finding support there. Up here, we have a remembered line because it's really at that line. I think the difference between this and this is maybe 1 or 2 pips. Okay, so the market remembered that area. When else did we remember that? When did we remember that area? Well, today. Today the market came right down to the 112, 13 or so level, and the market found or had buyers down there. Now, or at least people took profit down there. They had to wait through the CPI data. The CPI came out a little bit weaker, and so the market moved higher off of that level. But there were profit taker buyers right down there against that level. So now that we have 1, 2, 3 yellow circle, is that going to be an important level through tomorrow? And the answer is yes. Get below the 112.13 level. Let's say we go below the 112.13 level. Can you use that level as a level to lean against, to define your risk, to limit your risk? So if we go down through 112 and you sell at 111.97, yes, you still need to get below the 100-day moving average. Yes, you need to go below the 61.8. But you can define your risk against the 112 or that 200-day moving average, or this area 112.13. The remembered line, I should say. That area becomes your risk-defining level. And so now we have a defined risk level. Sell at 111.98 below 112. Put your stop above the 112.13 level, and you're okay. The other thing is maybe the 200-day moving average. You think that level is important. Well, we went below it here today. We've been above and below it through here. You might say that this move to the upside, we should have gone higher here. We didn't. We came right back down. This time we went above it, and then we found support against it here. So the market is paying attention to the 112 level. It's kind of like the 100-day moving average down here, just a little bit more closer in through here. Just only the last 3 or so weeks of trading, we found resistance here against it. We went a little bit above it here, couldn't stay above it. Next day we came down, went all the way down to the 100, then moved above it here, and then notice how we found support against it here. Today we went above and below it here, as I said, but we did find support against this old remembered area. So this area right here is going to be probably, or the 200-day moving average is going to be step number one on the downside. Step number two, we get below the 112.13 level. Step three, 61.8 in the 100-day moving average, and then we open up the door for further downside here. So those are the steps to the downside that we'd be looking for in the euro versus US dollar. I forgot about the 50% retracement level. That's the midpoint. That's where we're at right now. A nice area, which kind of makes sense for why the market is around that area right now, right before the Fed decision. Why are we sitting around the 112.59 level? Because what do we have? We have a 50-50 shot that the Fed's going to tighten, the Fed's not going to tighten. That means we have a 50-50 chance that the dollar's going to go higher, the dollar's going to go lower. And so where would you like to be if we have a 50-50 chance of something happening in the market that could send the market the dollar either higher or lower? Where would you like to be? Right in the middle of the most recent 7-month trading range. And coincidentally, that's exactly where we're at. We're actually at 113.02 now, and look at the price now. So we're a little bit higher than that, but we're in the ballpark of being right in the middle of a 7-month trading range. Isn't that weird? Not really, given the uncertainty and the 50-50 chance of the whole market. The market's going to settle around a place where it can move away from. And where can it move away from? The 50% retracement level. So we've pretty much taken care of the downside. 50% retrace with the market currently trading at 113.02. As long as we stay above that level, we're going to look for the move below the 50%. Then we're going to look for the move below the 112.33, the 200-day moving average. And we're going to look through this remembered line right here of 112.13. And then we're going to outline the 61.8 and the 100-day moving average. And that is going to be our roadmap to the bearish side. If we get below all those things, would you say that it's more bearish for the euro? Yes, we're taking out key levels: 50%, 200-day moving average, old remembered line, 100-day moving average, 61.8% retracement. Watch out below if we get below those levels. Okay, watch out below. We should see the market move further to the downside over time through that level. So that's my roadmap. That's my roadmap for the trade after the fact. After the fact, and depending upon how fast the market goes or where it goes, what steps it takes, you can lean against each of these levels. Do you understand? You can lean against those levels to define risk and limit risk against those levels, and that is the most important thing in trading, is that we as traders can define our risk and limit our risk against key technical levels that I can see, you can see, everyone in the world can see. Can you see these levels? Do you see why they're important? If I can see them, other traders can see them, and other traders believe in them and use those levels to keep the risk to a minimum. We are going from, what I'm doing here today is going from a very risky event and taking it after that and making it less risky by finding these key levels along the way. And so I get through that event risk and I move back to technical risk or price risk or risk that I can define and limit using technical tools that a lot of people see and use, because we run our business, our trading business, as a business. We want to make sure that we understand our risk at all times. So that's look below the level. Now let's take a look at other levels above. Okay, and if we take a look at this chart here and where we're at and what we have ahead of us on the top side, and again we're trading around the 113 level. What is the red line? Okay, the red line, this red line right here represents this trend line. This trend line connects 1, 2, 3 different points along the way. Actually, there was a fourth point right here. We came right up to it the next day. We broke through it, raced to the upside. That moved. All these stops were triggered. Why were they triggered? Because we went above this nice little trend line right here, and then we went. Well, I'll talk about that later. But we went above this level right here, and we came right back down to it. And we held support and we moved all the way up here, and then we came down to it and we fell below that level and stayed below that level all the way down to our 100. just watch the story develop. You can see the story develop. Come up to it, break through it, race to the upside, come back down to it, test it. Okay, we're still good. We're still good. Now we're not good. We went all the way down, moved down. What do we do just 2 days ago? We came right up to that red line, right up to that trend line, and we found resistance against that old trend line. Now, someone would say, well, is that trend line still good? We broke through it, so why do you still have that trend line up there? Well, traders still pay attention to it. We had 1, 2, 3 different points on it. It was nice, actually 4 different points here, and we held the underside of it right here. Traders pay attention to that. They see that. Don't take out old trend lines that have a number of different points on it. And I failed to put them there. There's actually 4. There's 5 right here testing the underside of it, and this would really be the 6th point 2 days ago. So that's a key level, and if we move higher, where it's currently at 113, the first real stop to get above and stay above is a 113.73-ish type area. Really, the 113.65, which is a 38.2% of the 7-1 trading range, and the 113.73. Get above that level and stay above that level. That's bullish. You can lean against that level as support. That is, if it goes to 85, you buy at 85. Where would your stop be? Down below 65. Okay, so you're only risking 20 pips on the trade as opposed to risking 200 pips on the release. Okay, that's the way you trade. So 113.73 is the next level on the top side. I think that answers your question as far as what is the red line. There you go. All right, what's the next key level? Well, we have another remembered area here. Remember, we had the remembered line here where we actually came up to the line. This is a remembered area, or what I call a remembered area, where we have a range of highs and lows. And just blur your eyes a little bit and see how the market comes up to this high, moves lower, all the way lower. And then we come up to this high, and we find this, we go a little bit higher, and we fail, and the market comes all the way down. And then we come back up to that level, and you can see the market you found sellers. So this is a remembered area. I can see it. You can see it. Everyone else can see it. It can see it, right? And then we have this failure to the upside. Let's move to the upside, which is an extension, extreme, and it failed, and it came back down. And we couldn't get up to that level here. So this becomes our next target on the top side. 113.73 goes up to 114.35 to 65. Now it's 30 pips up there, but that is an area that we're going to need to get and stay above if we're going to move higher here. Alternatively, you can look to sell if you're dollar bullish still, and we get I don't know, the Fed, whatever reason, we could have volatility, stock market can go up, the euro can go higher, who knows, but if the market comes up to this area, we should find sellers up here, resistance up there, and you can sell against that level and look for the market to rotate through that level. What's your risk if you sell in this yellow area? If it goes above it, okay? We've only been above it for 2 days right here. And really, and so there should be resistance up at this area right here. So look for it, okay? Look for that level, and and the other level up here is this high right here, going back to the high in February. That level came in at 115.33. If we get above this level and stay above this level, and then get above 115.33, we're probably going to go all the way up to 117.11, or that is the potential to move all the way up to that level at 117.11. All right, so in summary, what we see here on the daily chart is we're trading around 113. We're above the 50%, so we're more bullish going into the number by about 50 or so pips. I would say that's a pretty big line in the sand, as is the 200-day moving average. If we start to move below the 50 and 200-day moving average, look for further selling. We're going to have these targets to get through at 112.13. If we can't get through 112.13, we go back above 112.33. Take the trade off, folks. It's not working. We should see the price move below this level. We should see the price move below the 200. And if that should open up the door for a break below the remembered line. And then we'll see what happens at the 100-day moving average, 61.8. Another key level right here. If we get through all this cluster of support right here, 1, 2, 3, 4 different points, it's open door ahead for further moves to the downside. It opens up the door. On the top side, we need to get above this 113.73 level, which is also 38.2, and then we need to get above the 114.35 to 65 level. If we get above those levels, I think it's up to the upside as well. And whatever causes it to happen, that I don't really know. Now, the thing about this distance between here and here is that there's a pretty good distance in between that level and some other distances between that may be important as well. Now we're up here at the 113 level. So this is an hourly chart. And so we've kind of moved above what was going to be my targets up here. I was looking at this trend line right here. Notice this channel here. We have a nice little channel. Now we're above the 100. Currently trading 113.09. So we're kind of moving up toward our next target area up here. But this gives you sort of interim levels here. Looking at the same thing that we did on the daily chart. This is a remembered area. Why is a remembered area? We have a high here. We have a high here. Swing high, lower swing high. We came up through that level. Then we found support in that yellow area. We found it again. We tried to stay above that level. And we fell below that level. And then we used that yellow area as resistance. So this area right here between 113.19 to 31 is resistance. And with our currently trading at 113.08, I would expect that traders here today would look to sell in this area, kind of keep a lid on it in this area, and then we'll, just as a trade before the number, and look, if we rotate down to the 100, I think that's probably going to be our support down here against the 100 bar moving average against the trend line. But we have a whole 24 hours between, more than 24 hours between now and then. So this chart is going to change, it's going to look different, but I will look at my hourly chart and try to find certain levels along the way that are interim, kind of give me a little bit more a clearer picture where perhaps on the daily chart we have big gaps in between what it says support and resistance. Now not so much. When I did this earlier, we had a big gap in between here. Now we're kind of in between those two levels, aren't we? With the hourly chart, but you can use the hourly chart. Just do the same thing. Look for the levels that are important. Trend line, remembered area. This is an overlay of the daily chart or daily moving average right here. You can see that that's important. And down here at this trend line right here, that's going to be a key level as well. So just do that on your hourly chart. All right. So hopefully you have an idea of what the key levels are in the daily chart and why, and also how to trade that. Now let's do the same thing sort of for the dollar versus yen. I'm going to be a little bit quick, not necessarily quicker, but we're going to kind of do do a bunch, not have as many charts. Well, one of the reasons why is because remember the euro dollar, we were in a range for 7 months. While we've been in this range now, this blue box here for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, maybe 11, 10 months within this blue box right here. We had an extreme up here. We had another extreme up here last month. Down at the bottom, we've pretty much had some extremes in here. So the market, what do we know? Well, the market's been in this range between 124.50 and 115.50. So 100,000 pip trading range, still pretty wide. Now I've outlined some key levels here, and one of the key levels where we're kind of at, we're trading right now. In fact, we're trading at 120.48 currently at the moment. But like the euro, if you take the in this case, the most recent high down to the low, it's not the range of the last 10 months, but it is the most recent trading range of the last 3 or 4 months. The midpoint of that range comes in at 120.68. We're currently trading at 120.46. And we're also near the 200-day moving average at 120.80. So with the current price trend at 120.46, we're within 40 pips of being right at the happy point, the 50, the midpoint, the the apex of the seesaw, the point where it's bullish above, bearish below. So this is my area right here that is of extreme importance. If we stay above, if we move above it, that's going to be bullish. If we move below it, that's going to be bearish. So Fed tightening, Fed doesn't tightening, or some other combination that causes the dollar to get stronger or weaker. Bond yields go up. I don't know. Stock market rallies instead of goes down. Who knows? But this is going to be my key technical area through tomorrow. Is going to be between the 120.40 to 83 level, which and the 200-day moving average. Now let's start to break down other levels here. I'm going to start by putting in this trend line, and this trend line, like the other red line that was in the prior chart, it had a strong level through here, and then we broke through it. Moves strongly to the downside. And where do we come right up to? We come right up to the underside of that trend line. And so that's going to be important here in trading tomorrow, that top side trend line. Also, we have the 100-day moving average. That's going to be key as well. So earmark those lines. Draw that line through there. Put your 100-day moving average up there around the 122.37. We're starting to build the roadmap for the upside here for the dollar versus yen. All right, now let's get into the reason why I wanted to show those lines through there is because the next chart I kind of put all the remembered areas, all these yellow areas, and I outline why they're so important. And remembered areas are areas that the market finds, that goes and finds support or resistance against these levels on a continuous basis. So if we start here at the bottom, we have a low here, we have a low here, we have a low here. It's not by accident that we find these lows. The market uses these levels. At point number 4 here, even when the Dow is going down 1,000 points, we did find support near that area. Now it was about 50 pips away from the low extreme right here, but we'll give it the benefit of the doubt. Okay. Now let's look at this next area right here, this green area. Look how count the different lows through here, and there's actually more because there's some right here. There's a low right here. There's a low right here. These are all swing lows, swing low, swing low. We break below it here on the 1,000, but we reestablish the line right here. Okay, this was stops being triggered. Oh, well, reestablish the line. Ignore this. This is an extreme. This is stops being triggered. They ran my stops. Yeah, they ran your stops. Okay, and then they reestablished support there. So this area right here, key area, 118.22 to 50. You can see all the different lows right there. Ignore the 1,000, and this thing is looking like solid as gold right there, and that's why I put it in yellow, because it is solid as gold. So this level is going to be a key level on the downside. Let's go up to this yellow area right here. Look at all the different swing highs, swing high, swing high. Break above it. Try to stay above it. Try to go higher. Can't go higher. Move back down below it. Come back up to it. Come back up to it. Come back up. Break above it. And when we find support into it, go up, back up it. Come back down to it. There's a reason why it all happens right here, okay? This is where the magic happens, right there. There's a level where the market remembers. And so in the last few days, we've seen the market come up to this yellow area and find resistance. Let's go to the red circles here. Another swing high right here. And when we break above this yellow area, where do we find? Can't get above this target area up here, right here. Market starts to rotate back to the downside, back down to our trend line, move above it, move it to it here, and then through it here. Do you have any wonder why we saw stops being triggered right here? Because of these highs right here. So the market remembers, just like and the market remembered right here and we moved back higher, and the market remembered right here and we moved back higher, and then it broke through here and came down to our trend line and then moved back. There is a rhythm to the technicals here, folks, and we break below the 100 and we break below this yellow line, and it's Katie bar the door to the downside. You probably had an opportunity to sell right here against 100-day moving average and this remembered area, and traders did, and that's what forced the market to the downside. And we come back up to this area right here and we find resistance and move to the downside. So this is another key area on the top side. And finally, this remembered area up here. Extreme, 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 but in between we had 1, 2, 3, 4, 5, 6 different highs right there, and so that's going to be another key level. Take a picture of this. See these levels. This is a roadmap for either bullish or bearish. If the Fed tightens and we move higher and we move above this area right here, where we have this remembered line, where we have this trend line, where we have the 100-day moving average, don't you think that's going to be important? I do. And I will give up this move from here to here to be able and trade above this level with my risk defined against this line or against this area right here. I would do that trade after the fact than the trade right here. More risky, less risky. Risk is defined and limited right here. On the downside, where would I look to sell? Right below this golden area right here. Okay, all these lows right through here. Discount that down 1,000 day. If we go below the 118.22 level, the 60 level, or 50 level, we're going to be looking for the market to move lower and stay below that level. That's what we're looking to do. And once again, you can go to the hourly chart here, and you can try to find different levels that are most important here. So if we remember on the daily chart here, this level comes in at 118.22 to 50. Really there's a big gap in between here, 118.22 to 50. So you go to the hourly chart and you look at your hourly chart and you look at 119.53, 119.63. That's a nice remembered area. Low here, low here, low here. Failed, low here. Break below, stay below, stay below, stay below, stay below. We're trying the downside. Oh no, back above it. Find support. Had a little come to Jesus right here. Didn't find support here. Failed. Moved back above and moved higher yesterday. This is all about the failure yesterday, but we did find support here and here on the other side. Moved back above that level. So this is an area that's going to be important. Also of importance with the test of the 200-hour moving average in trading here today. Is this 200-hour moving average? It comes in at 120.10. So go back to your daily chart. Look at 120.10, which is up around here. Break below that level is going to be a key break on the downside for the dollar versus yen. All right, I'm getting. If you want this slideshow, you can always send me an email at greg@forexlive.com if you can't get the if you want these charts, and you can we'll see how it all pans out. But the point here, folks, is that risk is great. It's a 50-50 shot. I can go do 50-50 all day long at the casino in Las Vegas, or bets in that vicinity. Okay, I'm not here to bet. Okay, and I don't think you are as well. I hope you aren't. So what you need to do is instead use your technicals, use your knowledge, and apply it after the fact. Find those technical levels that you can see, that other traders can see, where there has been support and resistance again, and it's proven itself via remembered lines or moving average lines when the market holds, or trend lines that I've demonstrated here today. Market sees these levels, they know these levels, that's why they trade against them, because they can define risk and limit the risk against those levels. And so use those levels. Use those levels to your advantage, and use them after the fact tomorrow to define your risk and limit your risk, and do your trading that way. Alternatively, take the day off, come back the next day. These same levels will still be in play, and the market will have all its stories done, and have all its all the economists and everyone else telling their story, and trading will get more normal at that time. One final commercial, if you will. I have a few slots open for the Attacking Currency Trends course. It's going to start on Friday, September 18th. It's amazing I got this webinar done on top of that. Friday, September 18th, with classroom sessions on the 18th and 19th. Those go from 9 a.m. to 1 p.m. on Friday and Saturday, where it's going to take place online, and then we continue it on Monday through Friday, the 21st to 25th, in our live trading room. We're going to apply what we learn in the Attacking Currency Trends course. We limit the enrollment. We only have a few spots left. If you're interested in that, you can go to our website at education.forexlive.com. As I like to say, good fortune with your trading, and understand that it is trading. It's not gambling. Okay, folks. So take that into consideration. And I want to thank the people at Forex Live for allowing me this opportunity to speak with you here today. My book hasn't been translated into Russian. No, not yet. No. I wish it was. But anyway, thank you. Bye-bye. Have a good day. If there's any other questions, I didn't see any. So if there's any other questions, let me know. All right. We're good. Thank you very much. Bye-bye now.